Well, in planning for retirement for our clients, one of the most important details we need to understand is what their living expenses are. What are they spending on a month-to-month, year-to-year basis? And I'll tell you, that is the number one detail that most clients don't know the answer to initially, but it's one of the most important details that comes into the equation of, have you saved enough, or how much more do you need to save in order to have enough to retire? Another really important detail to understand about our clients in the retirement equation is where they want to retire to. Some states don't have income taxes, and that does help in the equation for retirement planning. Also, how many homes do they plan to own? Is it a primary home plus a vacation home, or more than one vacation home? And so any assets in real estate, such as vacation homes, are illiquid assets that you have that aren't generating an income for you in retirement for the most part. So we need to understand that balance between liquid and non-liquid asset needs in retirement. One really important point for all investors to remember in planning for their retirement is that the stock market does typically go down every single year, on average about 14%. That's the average intra-year decline over the last 35 years. But in 27 of the last 35 years, the stock market has actually ended in positive territory. So what that says is intra-year declines are normal, but it doesn't mean that the stock market is going to end in negative territory for the year. So we need to have patience to sit through the good times and the not so good times in the market to get the returns that we need over the long haul for our retirement. And for most investors, they'll have a 20 or 30-year retirement time frame, and the investment returns they need during that time frame are not going to happen overnight. There's a lot of really good time-tested retirement planning strategies that we use for clients and other advisors can continue to use for their clients. One of those retirement strategies is making sure our clients, especially those about to go into retirement or that are in retirement, have enough cash in the bank. Cash is so important, especially when you're in the retirement phase, because if you're otherwise living off of your retirement portfolio and you have a serious downturn in the stock market, it's a good time to turn off your portfolio withdrawals, take cash out of your savings account in the bank to pay your bills, and then wait for the market to rebound from, let's say, an unusually large dip before you start withdrawing from your portfolio again. So having the cash cushion in the bank allows our clients to continue paying their bills, living a normal retirement lifestyle, and they're able to ignore the fact that their investment account may be down temporarily. But by not taking withdrawals during down years in the market, you can actually add years to the life of your portfolio on the back end by not selling low. Another really good retirement planning strategy, and this is really more for those that are what I would say in the accumulation phase, those that maybe have 5 or 10 years until they get to retirement, is to make sure they are maximum funding their 401ks every year and their IRAs. That may sound very basic, but you'd be surprised how many clients simply don't do that. And especially those that have what I call a big birthday at age 50, and they're now able to get another $6,000 into their 401k plan. A lot of clients just forget about that, or they tend to miss that, but putting an extra $6,000 a year into your 401k plan, say over a 10-year period, could add up to a significant amount of money by the time that they're able to retire. And if you're putting that money in pre-tax, it helps save on the tax bill today in terms of contributions into your 401k plan. A third strategy that clients should implement in the accumulation phase of their life is to have automatic withdrawals coming out of their checking account into their various investment accounts every month. And the reason that's important is if that cash is not in your checking account, you are not likely to spend it. So it's a way to keep yourself disciplined without actually physically writing a check into your investment account each month. So for example, let's say I want to make sure I'm saving at least $3,000 a year into my brokerage account. Well, I can have an automatic draft of $250 a month from my checking account to my brokerage account. Again, that money's never there for me to spend, but it's getting invested, and investments over a long period of time can add up to a lot of money in your retirement portfolio.